Hey everyone, welcome back to Advanced Accounting. In the last class, we talked about the current rate method and the temporal method. Let's now first do a brief review. So the current rate method, it is used when the functional currency is the foreign subsidiary's local currency. Actually, if you still remember, we have that graph of local currency, functional currency, and the parent firm's reporting currency. From local currency to functional currency, we use the temporal method. From the functional currency to the parent firm's reporting currency, we use current rate method. So if the functional currency is the foreign subsidiary's local currency, which means those two are the same, we don't need temporal method, we only need the current rate method. And under the current rate method, all of the assets and liabilities, we translate them using the current rate. Equity account, we use the historic rate except return earning. Income statement items are usually translated using the average rate. Gains and loss from translation goes into OCI and eventually recognized as cumulative translation adjustment. So current rate and current rate method and temporal method. So if the functional currency is the parent firm's reporting currency, under this situation, we don't need the current rate method. We only need to do the temporal method. Under the temporal method, functional currency, so that's just what we just talked about. Under the temporal method, only the monetary accounts are remeasured using the current rate. And all of the non-monetary account and equity account will apply the historic rate. Income statement account items, we usually use the average rate, except non-monetary items are remeasured using the historic rate. So here, if the firm is using temporal method, we usually need to start from the firm's balance sheet and goes to the statement of return earning, and lastly goes into the firm's income statement. And gains and loss from remeasurement that is recognized on the firm's income statement as a plug. So, and then we also talked about the two quick ways of calculating translation adjustment and remeasurement gains and losses. So you just, if you do not remember, just go back to review last class lecture video. And in today's class, we're going to talk about consolidation. So consolidation, when the firm has a foreign subsidiary, it needs to go through three steps. This is already assuming that foreign subsidiary's financial statement is already being converted into the what it should be using the US GAAP. And now we only need to do first of all translation. So we need to translate the foreign subsidiary's trial balance from foreign currency into US dollars and calculate any translation adjustment or remeasurement gains and losses. So that is step one. And step two is, what do we do on the parent's book if one of its subsidiaries is a foreign subsidiary? So here, we actually has a 3-by-2 situation. So the parent can either use the equity method, the partial equity method, or the initial value method. And also, the parent may use one of the two translation methods, the current rate method and the temporal method. So if it is only if the parent is using the equity method and it is also using the current rate method, do we need to make this general entry, which is to debit investment account, credit cumulative translation adjustment. So this is the parent general entry. It is only under this situation. Under all of the other situations, if the firm is using partial equity or initial value method, we don't need to do this general entry. And also if the parent is using the temporal method, it is already, any of the gain or loss from translation is already included in the firm's net income. So we don't need to do this journal entry neither. It is only under this situation do we need to make this journal entry, which is to debit investment account credit cumulative translation adjustment for whatever cumulative translation adjustment it is. So, and then for step 3, step 3 is to make a consolidation worksheet. And on the consolidation worksheet, we're going to introduce 2 new consolidation entries, consolidation entry E2 and consolidation entry T. And before I go into the specific consolidation entry, I just want to tell you that for consolidation entry E2, we only apply it under the situation when the parent is using the current rate method. And why it is the case, I'm going to talk about it later when we go through the example. And for consolidation entry T, it is only used when the parent is using the equity method and the current rate method is used. So this is basically to reverse the parent's the journal entry made by the parent. So that's why we only make the entry T in this situation. And so those are the 2 new consolidation entries we need to make when the firm has a, so when the firm has a foreign subsidiary. And now let's look more detail into the step 2, if the parent is using the equity method. So if the parent is using the equity method, just as this is just what I just mentioned. So if under the temporal method, the remeasurement gain or loss, it is already included in the subsidiary's net income. So there's no need to do anything. We just need to make the regular journal entry when the subsidiary reports its net income, which is debit investment account, credit equity in subsidiary income. So but this entry should already be made to record the earnings reported by the subsidiary. So there's no other journal entry that needs to be made here. And if the firm is using the current rate method, the translation adjustment increased the subsidiary's equity, but it is not included in net income. Actually, it is included in OCI. So just as what we do for OCI, now Ch8 translation adjustment is part of OCI. So we need to debit investment account credit cumulative translation adjustment. So, and then, yeah, so, well, so one thing I need to kind of mention here is, so it is viewed as should be included. So it is viewed as the nature of it is very similar to OCI, but it is not really included in OCI. That's why we need to make an additional journal entry. And then under step 3, so step 3 are the additional consolidation entries that needs to be made when the parent, or when the firm has a foreign subsidiary. So under this situation, if the firm is using temporal method, we do the same thing as before. We do exactly the same thing as before. There's no other consolidation entry that needs to be made. So specifically because non-monetary items are remeasured using the historic rate, so the consolidation entries are unaffected by the changing exchange rate. We're going to when we look at the example, we will talk about it using more concretely using our example. So consolidation, we just do it the same way as before. S entry for eliminate subsidiary's equity account at the beginning of the period. A entry, the difference between face value and fair value and book value. I entry to eliminate parent's income from subsidiary. D entry to eliminate subsidiary's dividend. And E entry subsidiary's depreciation and cumulative depreciation. And however, if the firm is using the current rate method, so that's when we need to make additional consolidation entries. Because when the firm is using the current rate method, all of the assets and liabilities, they're translated using the current rate. So which is affected by the changing exchange rate. So there are some consolidation entries that are affected. But for S, A, well, kind of so D, we're still kind of doing the same. Until the E entry, we need consolidation entry E2 to revalue the excess of fair value over book value for the changing exchange rate. What do we mean by this point? When we look at the example, I will talk more about this. And if the parent is using the equity method, we also need consolidation entry T to eliminate the translation adjustment recorded by the parent's investment account. So we're going to talk more about this point later. But so basically consolidation entry E2, the entry is to debit asset or liability, credit cumulative translation adjustment. And for T entry, the entry is to debit cumulative translation adjustment credited the firm's investment account. So this is just a conceptually, I just went over what we do in consolidation when the firm has a foreign subsidiary. And now let's look at an example.